We have as our final speaker before lunch Mr. Rahul Singh, CIO Equity at Tata Mutual Fund. Mr. Rahul Singh has over 26 years of investment management experience and will today talk on equity investing in a new India in a changed world. Over to you,
Thank
sir.
you, everyone. And once again, I thank you for giving Tata Mutual Fund and me the opportunity to address you and wish all of you a very, very happy new year. And I know I'm cutting into lunchtime, but I will make it worthwhile for you because I think the speakers before me, Pradeep and Usha, have set the stage for me. I almost thought that it was planned because what I am going to give you is, while Usha talked about how dominance is going to change, I'm going to tell you who is going to dominate and what is going to dominate in the equity investing world. And also what kind of frameworks and what kind of investment processes are going to dominate over the next, I think over the next 3 years at least. So the topic which I have chosen is equity investing, new India and a change world, and let me explain that a little bit. And I think I think that comes at a very interesting point of time because the rest of the world is going through this, either this or this, while we are stable to going up. So it creates a lot of tension in the equity markets, a lot of confusion in your minds and as to how we should look at India. Yes, we are positive, but the valuations X, Y, Z and so on. And it all culminates into the second point which I wanted to make to set the stage for my discussion, which is that globally, if the interest rates are going to not go back to 1.5% in the US, and if all the easy liquidity environment is definitely gone for good for next 2 to 3 years, then as a concept, valuation discipline, I won't call it deep value or a value approach, but valuation discipline is going to come back. And this is where I will talk about what we do at Tata AMC, what is our checklist, which Pradeep was mentioning about, and how that fits into what is going to work in the next 3 years. But also, I will talk about how should we look at India's valuation, because that is the single biggest sore point. Yes, everything is fine or relatively fine, but how do we look at valuation and how should we look at markets in the short term, in the long term? And the most excited thing, most important thing which I'm excited about is that the investment cycle is reviving. And as fund managers, I am now old enough to remember 1990s to 2020. We have seen, last 10 years, the fund managers have been waiting for the investment cycle to revive. I mean, it's been a long wait for the real estate sector to revive, and now it's happening. So let me first jump right into what are different philosophies in fund management. So there is a deep value approach, which is at one end, and then there is quality at any price, growth at any price. Now, last 10 years, you have seen a market where growth at any price, quality at any price, those kind of philosophies have worked because we were in an easy liquidity environment. And because the interest rates were low, the equity assets kept on getting repriced. Now we are in a different world and we are looking at a scenario where the inflation is persistent in the developed markets. Interest rates are going to remain higher for longer, maybe not go up much more from here, but they are going to remain here. So therefore, valuation discipline becomes important. And what we do at Tata Mutual Fund is we have a approach which is, some of you would have heard this term, or I'm sure, which is growth at reasonable price, GARP. But GARP is a very wide term. GARP can be misused. GARP can be interpreted by different fund managers differently. So what we have done is we have defined it clearly in 3 different segments. And we run all the companies, all the investments we make in these 3 categories, which is value with trigger. So we are not deep value investors. We don't buy value for the sake of value and wait 4 or 5 years for it to emerge. We know that strategy does not work in India. A deep value strategy works for some time, but it does not work over a long period of time. So we always have to look for growth, but at a reasonable price. The second category we'll look at is earning upgrade cycle, where we think, based on our analysis, that the companies are going through a cycle of upgrades, which is what is happening in banking sector today. It is happening in capital goods, industrial, manufacturing. It is happening in real estate. It might happen in IT tomorrow again, or it might happen in pharma. So our idea is to identify these sectors which are in the middle of a 2-year upgrade cycle, and then you get the alpha from there. The third segment is more thematic. I mean, today, for example, we think that manufacturing as a theme, I think we might be entering a phase where India is just so well positioned that that geopolitically that we might, I mean, if the government policy is right, which it seems to be, then we will end up with a long period of manufacturing outperformance, which has not happened. So if you look at, and this is related to something about large cap, mid cap, small cap. If I look at the large cap space, there are hardly any manufacturing companies, hardcore manufacturing. In Nifty 50, there are no manufacturing companies. I mean, it's a shame that a country as big as ours doesn't have a hardcore manufacturing company in Nifty 50. That just tells you where we are in the cycle and how much there is to go as far as that theme is, concerned. And I think before I come to this slide, one small example I want to give you is that today, why is Europe vulnerable? Because Russia supplied natural gas to Europe. And therefore, Russia-Ukraine war, while it is not settled, Europe is almost on its knees. Now, tomorrow, if something happens in China and Taiwan, the entire world is dependent on manufacturing parts, semiconductors on China and Taiwan. And the world realizes that. The world knows that this is a risk because they don't know what is going to happen in China and Taiwan after 3 years. And therefore, there is a lot of focus in the world today to develop India as a sourcing hub. When we meet companies regularly, all the manufacturing companies, MNC companies, almost all the companies, it's phenomenal. I mean, this is not government speak or this is not economic type sideline, but what we see at the ground level from the companies is that almost all MNC companies today want to develop India as a sourcing hub for manufacturing. So that's the long-term trend which we are seeing, and that is what is making us very, very positive on Indian economic growth and Indian profit growth. And just talking about profit growth, this is what has happened in the last 3 years, and this is the story of India always. That real GDP growth rate between fiscal 19 to fiscal 22, so pre-COVID to last year, the real GDP growth rate was only 2%. The nominal GDP growth rate was 8%, but Nifty 50 EPS grew by 19%. So this is where the the strength of the the companies which we have comes through. That even if the GDP growth is 4-5%, let's say next, I think it will be higher than that, but let's say the GDP growth rate is 5-6% next 2-3 years, I think we will be able to grow profits at 15 to 20%. I think that's the real kind of advantage we have in India, and that is why our profit forecast. So when I look at our profit forecasts for next financial year, they have not come down. Despite the Russia-Ukraine war, despite the inflation, they have not come down. Yes, certain sectors have come down. IT has come down, but banking has gone up. Urban consumption has gone up. Real estate has gone up. Capital goods has gone up. Manufacturing has gone up. So, we have a very excellent breadth in the markets, which keeps the overall profit performance or overall profit forecast not too unchanged from what we have seen. Now let me come to the most, the trickiest part of the presentation, which is India's valuation. India is at 19p, China is at 11p. That is the kind of difference we have. Now, why is that happened? It's very important to understand, and what can happen going forward, therefore, is dependent on understanding why this has happened. Why this has happened is that, China as a country is saying that, okay, I am not interested in growing at 6-7%. I am okay to grow at 4-4.5%. I don't want to create massive market capitalization in companies like Alibaba or thing. I want to control the wealth, and I want to distribute wealth to general population. Whereas in India, it's the other way around. I think we have no such restrictions which are coming from the government. Government wants to push for growth. And also geopolitically, as I mentioned, I think India is in a sweet spot because everyone wants to develop India as a sourcing hub. And therefore, when I look at this chart and look at that India is trading at a 75% premium to other emerging markets, there is a reason for it. There are two main reasons, as I mentioned. One, we are much more stable. Second, China has gone down. And the third reason is that, you have a situation where India is not very externally linked to the US and European markets. So if there is a recession in US and Europe, which is bound to happen, I think, there will be a recession. Except for IT services, we don't have huge connectivity like China has, Taiwan has, Korea has, Philippines has. We are not so dependent on exports for our GDP growth rate. So therefore, we are standing out. Yes, what this brings us to is, a kind of a scenario painting or range of outcomes which can happen in the short term. So in the long term, just to reiterate, I think the investment cycle revival, manufacturing revival are extremely positive developments. We remain extremely positive of the earnings growth rate or the profit growth rate being in the 15% range for next 2 to 3 years. We also think that valuation discipline is going to come back, where we will play a huge role with our philosophy. We also think that there is a chance that in the short term, because the market valuations is at a high level or at a higher level, we might see a year where we might have a similar year like 2022. But mind you, there are certain sectors, certain companies, especially in mid and small caps, which are going through a very different cycle. So we remain extremely positive on our ability to create alpha. Some of our funds have created almost 3 to 10% alpha last year. And as a fund manager, if you ask any fund manager, and I am no different, we love this kind of a market where markets give low single-digit returns, but we, because of our ability to pick themes, pick stocks, are able to generate alpha. And I think 2023 is going to be a year like that. And there are 4 scenarios. I mean, I have just painted them. There are basically 2-3 factors. One is the slow recovery in China post-unlock and sharp recovery from China. And similarly on the US and Europe and UK, whether there is a shallow recession or a deep recession. I think the ideal scenario for India when the valuations can remain high is if there is a slow recovery in China post-COVID, and if there is a shallow recession. What do I mean by shallow recession in US and UK? Maybe 6-9 months of negative GDP growth rate of 2-3%. That's the best scenario for India because commodity prices come down, India continues to grow at a reasonable pace, and India's valuation premium remains. That's the best case scenario. In that scenario, you might get a 10-15% annualized return this year itself. But there are possibilities that China could recover faster because they have finally given up as a country, saying, okay, let COVID happen. I don't care. Which is what we were in during Omicron. That let COVID happen, let it get over with. And therefore, I think China is recovering slightly faster than what we would have ideally liked as a country, and therefore China can rebound. There could be some capital flow to China. We might drift. We might hang on to these valuations, or we might time correct and we might come down to 17.5 times P or 18 times P. At that point of time, I think then the stage is set for us to at least give 12-15% return from there. But mind you, this is, so I'm telling you as the thoughts are, our thought process is evolving. I don't want to mince words and tell you that this year we will get 15-20% return. At the same time, I am not in panic mode. I am looking for alpha ideas in mid caps, small caps. I am looking for ideas in banking. I am looking for ideas in manufacturing, capital goods, industrials, real estate, because those are the sectors which are doing well. And that is what makes me extremely confident that we will be able to generate alpha, even if the markets remain flat this year. I think there is a lot happening in the economy for us to be feeling good about the markets. I think the worst case scenario for India is if there is a deep recession in US, in which case, IT services goes for a toss. There are other implications of a deep recession, and there is a very sharp recovery in China. So commodity prices also remain high, and there is a global slowdown impact, in which case our valuation premiums might shrink. there could be some impact on the profit growth also. I don't think it is very likely, because it's very difficult to think through a situation where US, EU, Europe and UK goes into deep recession and China is in a very strong growth phase. It's difficult to envisage such a scenario, because China is also linked to US economy growth. So it's not that China is an independent economy, and therefore the pink one, kind of box looks little unlikely to me. Just a couple of quick slides before I move to the concluding slide, and I know my time might be running out. So basically, to understand why investment cycle revival is such an important development, we just have to remember one thing, that investments or capital formation is 30% of GDP. Now, if 30% of GDP does not grow, where does it leave GDP growth rate? It leaves GDP growth rate at 4% or 5%. With investment cycle revival, we can be at 5.5%, 6%, which is a pretty good number. I don't think we are going back to 7, 9% when the world is declining. But if we can go back to 5.5%, 6%, I think it's a very, very big achievement. And I don't know how many of you remember that pre-COVID, in the quarter of December 2019, before COVID, what was our GDP growth rate? Does anyone of you remember? I don't think people remember, but it was 4%. It was actually 3.9%. It's ridiculously low, because investments were not happening. Investments were just not happening. Real estate had not revived. So if these things don't happen, we'll go back to 4.5%. And therefore, this is the reason why we are very excited that the investment cycle is reviving. India is in a position to attract manufacturing investments, because world has run out of alternatives to have a sourcing hub. These are extremely important things for us to remember and keep our positivity towards why India should be at higher valuation than China. You can argue whether it should be 90%, 80% premium, or 70% premium, or 60% premium. But that's the point I'm trying to make. Also, if you go back in history and look at 2004 to 2008, when investments grew at 9%, 16%, that is the period when GDP grew at 9%. As soon as the investments declined, GDP could not exceed 6%. It was so difficult to grow even 6%. And this is what I think is a big change happening. And combined with the fact that you have a valuation consciousness, or you have a valuation discipline coming back to the market, makes it an extremely interesting market for people like us, for fund managers in general, and for fund managers who are much more disciplined in valuations, where growth at reasonable price, I think is going to be a dominant kind of investment philosophy. So how should one manage the investments? How my job at the end of this is not to just give you gyan, but also tell you how should one be positioned in the short term, in the long term, where to create alpha, where to protect capital. I think all these discussions are very important. And the way I look at it is that this year you need to manage risks so that you can grow much faster in the next 2 years. And how to manage risk is to have core allocation in balanced advantage funds. Because you not only take advantage of the volatility or any fluctuations in the equity markets, you also take advantage of the yields which are going up on the debt side. But even before that, you should have the right debt equity allocation. In this market, I think debt is also becoming reasonably attractive, at least till certain duration levels. So, but as far as only equities is concerned, because I look at only equities, I think balanced advantage funds become an extremely important part of the allocation. The second part, which is more specific to us, is that if you have to allocate money, you have to look closely at the investment philosophy of that fund or fund house or fund manager. I think gone are the days when quality and growth and just buying things at any price worked. The sooner you realize it, the better it is. And the sooner you devote some time and energy to analyze how the fund is managed, what is the investment philosophy, so that you're not caught on the wrong side in the next 3 years because interest rates have gone up and that old philosophy which worked is not going to work in the next 3 to 4 years. So I think there we have a combination of products, obviously large and mid cap, and our own value fund, which is equity P fund, some of you might be aware. We are also launching the multi-cap NFO in this month from 16th, where we will be, I think multi-cap as a category, just, 1 minute there, it forces you to look for alpha because you have to invest 25% in small cap, 25% in mid cap. And I think this is an excellent time for multi-cap funds also because, as I mentioned, if I have to participate in manufacturing as a theme, if I have to participate in cyclicals and recovery in the investment cycle as a theme, multi-cap and small cap, I think should be had. We should not be scared, or we should not be apprehensive of that segment because that is where the alpha will come from. So that's on the middle layer. And as I mentioned, we did not have a multi-cap fund. We are launching one. The real alpha can come from sectoral funds. Obviously, it depends on the risk appetite of the investors, but we still think banking as a sector can do well in the short to medium term, 12 to 18 months. Although it has done well already, I think there is more room there. We also think small cap is right now, at least as far as we are concerned, the best fund for you to play the manufacturing theme and the investment cycle revival. So you have to keep things simple. You have to protect capital using BAF, take advantage of the volatility, in fact, but also look for alpha. This is not the time. This is the time to be cautious, not panic. This is the time to manage risks, not move out of equities completely, because there are things which are happening, as I mentioned, in India, which we have all been waiting for, frankly, in the last 10 years. And we've got a lucky break because of COVID, Russia-Ukraine war, and so on. We as a country are getting a lucky break. So with that, I come to the end of my talk. Hope it was useful, and once again, thank you for this opportunity, and I hope you found it useful. Thank you.
Thank you so much, Mr. Rahul Singh. May I invite on stage Mr. Raghu NS and Mr. Jayana from Shivamogga branch? Yes. To kindly give Mr. Rahul Singh a memento.